Hi, this is Brandon Bischoff with Canterbury Investment Management, bringing you this week's market commentary for June 24th, 2019. The current market state is Market State 1, and that is measured on the S&P 500. We entered Market State 1 a couple of weeks ago, and recently the market actually hit a new market high. Now, 85% of market highs occur during Market State 1. Market State 1's risk is low, but because most highs do occur at this level, a pullback would not be unexpected from here on out. The market's actually reached this same level two different times before. One was in late April and the other one was in October of 2018. During the month of May, we saw a 6% pullback off the new high before actually rallying back to Thursday's high. The Canterbury Volatility Index measures CVI 63. That is again measured using on the S&P 500. Volatility got as high as CVI 70 during the decline in May, and actually on the 10-day CVI, volatility was as high as CVI 92. Now 10-day volatility is measured obviously over a much shorter time frame, and we recently saw 10-day volatility drop to CVI 52, falling back below the longer-term volatility index, which is an indication of lower risk. Now moving on to the market comment, we're going to talk about the advanced decline line. The advanced decline line is used to measure market breadth. So what we want to see happen is we want to see the market put in a new high, but also the advanced decline line put in a new high. So it shows the number of stocks participating in the market's movements. So in other words, if you had a market that put in a new high, but the advanced decline line did not, that would mean that higher weighted stocks or heavier weighted stocks are leading the troops or leading the smaller weighted stocks. So we want to see broad participation. So we want to see the advanced decline line and the market put in highs at the same time, which has actually just happened as of last Thursday. The AD line's at a new high, while the market's at a new high. And so if we look at an example of where this wasn't true, we can go back to the technology boom in 2000. So what we saw happen was we actually saw the market put in several new highs over a few months, while the advanced decline line actually decreased throughout that duration. And that would just go to say that technology was pretty much leading the way while everything else was kind of falling off. And then again, on a much smaller scale, we saw another negative divergence in 2008 where the market and the AD line put in a new high at the same time. But then a couple months later, when the market put in a new high, the advanced decline line put in a lower high. And again, that's called a negative divergence. So if we look at actually the style indexes of the S&P, large cap stocks have really led the market, which explains why the S&P 500, is composed of large cap stocks, so that would explain why it's sort of leading the way. It's had really strong performance. But if we look at actually smaller stocks, large cap growth's in first and small cap value's in last. Small cap growth and small cap value are exhibiting more bearish and transitional characteristics. So if we're looking at these two charts, we can see that large cap growth has actually put in a new high, while small cap value is actually putting in a series of lower highs. So being that we are an adaptive portfolio strategy, or the Canterbury Portfolio Thermostat is an adaptive portfolio strategy, we do not believe in benchmarking against individual indexes or fixed portfolios. And that is because we have the ability to adapt to all different kinds of market environments, whether they're bull or bear. Whereas a fixed index or a fixed portfolio is not. They're going to fluctuate during bear markets. They're going to become very volatile. They're going to do really well during bull markets. And so in a fixed portfolio, as your assets become really, really correlated, you're going to experience volatile bear markets. And so to kind of compensate for this, the Canterbury Portfolio Thermostat has developed its own key internal benchmarks meant to measure the efficiency of the portfolio. We want to keep that efficiency score in between 70 and 100. And what goes into that efficiency score are three things: portfolio state, volatility, and benefit of diversification, which is a measurement of how correlated the assets within the portfolio are. So today's portfolio metrics, the portfolio state is bullish, the volatility of the portfolio is CVI 40, and the benefit of diversification is 41%, which is efficient for today's environment. And so that gives us a portfolio efficiency score of 100. Thank you for listening to this week's market commentary, and we'll be talking to you next week.